If you look at the year-to-date, stocks, though, are slowly recovering from the losses of 2022. This is despite sort of the rhetoric out there, right? Stocks have been going up, even though we keep hearing about recession fears on the horizon, of the collapse of the second and third largest banks in history. So what's going on here? Should investors, as Savita Subramanian of Bank of America said in a recent note, should they come to peace with the rally that we've seen and actually go out and do some buying? That was the subject of this morning's morning brief on Yahoo Finance. Emily Bowersock-Hill of Bowersock Capital Partners, founding partner, and Chad Oviatt, Huntington Private Bank Director of Investment Management. Both of them are here now in the studio. And Emily, I want to start with you. So we've had this rally, which feels like one of these rallies that people aren't quite comfortable with, right, in terms of the year to date. Should they get comfortable with it, or should they be suspicious of it?
Well, I think, frankly, the rally is a little bit of a surprise, and I am not particularly comfortable with it. I don't think people should be comfortable with it. That being said, sentiment out there is really, really negative. And so the contrarian view is the market may know something that we don't. I do think the run-up in tech stocks is overdone, and that U.S. large cap stocks are richly priced at the moment. So I think it's a good time to pare back equity holdings. I'm not in the camp that thinks this is a great buying opportunity, especially when you look at the valuation of the market versus where it was right at the beginning of 2022. This is not a huge value moment, in my opinion.
Is there a tactical shift then that you would suggest people consider making at this point in time with their portfolio?
It's an interesting point in time for sure, because we're seeing things that we haven't seen in 16 years. Cash yields where they're at, bond yields where they're at. So for us, kind of the three legs of the public market stool, if you will, are in play. A concern we have is that clients may end up getting overcashed or oversubscribed to fixed income and moving away from an equity position. So for us, not so much a tactical play, but something we've been telling our clients at Huntington is stay balanced, stay neutral to your long-term target. So if your target is that traditional 60-40, 70-30, whatever it happens to be, make sure you stay close to that target.
Well, why? What's the danger of being overcashed? I mean, you're getting that yield.
Yeah, great question. And so what we would point to are the expectations, the consensus expectations that rates are going to decline. Right? So when you look at Fed funds futures, or you think about markets actually going into a recession, the bond market's been in an inverted yield curve. That would suggest to us that yes, rates are good now, but there's the potential for them to decline. So even from a fixed income perspective, we've been looking at opportunities to move from short duration to more intermediate duration to lock in some of these yields. Not that we see things moving all that dramatically here in the near term, but we have decisions to make. There may be tactical opportunities in the second half of this year. But given what the market is telling us, we're not overweighting equities to our long-term target. We're not overweighting fixed income to our long-term targets. We're just keeping that balance to wait for opportunities. And even as Emily was talking about, you think about the concentration of returns right now in the equity markets, it hasn't been that broad-based. So we're still being selective there too. And we would tell people, we've been cautious on international markets for a long time. We're starting to kind of nibble on the periphery there. We're making some moves into international, developed in particular.
And Emily, it seems like the markets have been giddy around the opportunity or a probability that they're foreseeing for a cut, but a cut and a pause, very different, obviously. But if there is one thing that is significant about them, either case, it's a pivot from the Fed's perspective, it seems like.
Yeah, I keep saying this. I do not think that the market is getting the Fed's message. And this idea that there's going to be a rate cut in 2023, I would be very skeptical of that happening. And I think what we're seeing here is some recency bias, because when you look at the last 4 significant rate hiking cycles that we've gone through in the last 30 years, those rate hiking cycles took place in a very different environment. I mean, it was a low inflation environment. And even those, the pause in those cases lasted from 6 months to 14 months. A pause is not a rate cut. And I think what the market is not taking into account is the idea that we could have a pause that extends significantly longer than 14 months. I think it's going to be difficult to get back to that low inflation environment that most people investing today, are used to. This is what they've spent their whole career in an environment like that. And so I think that is preventing them from really hearing what the Fed is saying.
We've been talking super high level. I want to get a couple picks from each of you before we run out of time. Chad, you in your top equity holdings for your stock strategies, and I realizing that things are tailored for different people. Sure. But Emily was saying she's not a fan of getting into necessarily big cap tech right now. You guys are looking at the likes of Apple, Microsoft, Nvidia in your global growth strategies. Mm-hmm. Why are you still looking at those stocks?
Well, so it's more about what the next several years hold. Today, obviously, is going to be a big day. We have an earnings announcement coming after the bell. But for us, it's more about the quality of those companies, things that they're going to be working on. AI, obviously, getting the big topic of discussion now for the likes of Microsoft. But, even AI, Nvidia will play in that because there's a lot of infrastructure required. That's a lot of processing power that has to run that. So when we think about our clients at Huntington, they're longer term investors. So it's not about today or tomorrow. It's about those companies doing well over the next 3 to 5 years.
And Emily, what about your picks?
Okay.
Anywhere specific?
Yes. In our case, we are also very long-term investors. We're not traders. And one of the themes, a very important theme, and people's eyes tend to glaze over when I say this, I think people are not anticipating the impact of climate change over the next 10 to 15 years and the fact that we are going to continue to see supply shocks in increasing frequency and severity. And so we're trying to find companies and parts of the market that will benefit from a continued inflationary or at least higher inflation environment than what we're used to. And so we're looking at basic materials companies, companies that are leading to cost savings and energy savings. And I would put, for companies generally, and I would put Ecolab into that category. I would put Corning into that category. We're not buying a stock for the next 6 to 9 months. So, yes, I think this technology play makes sense, but we really want to figure out what is the risk to people's portfolios? What are the unanticipated risks or the unappreciated risks? And I think climate change and the supply issues that we're going to see are not being fully appreciated.
And finally, because both of you seem on the same page in terms of time horizon, right? And so I would ask each of you quickly, are clients on board with that? I feel like as humans, right, we're very short-termist, right? But in your portfolio, it's probably a good idea to not be quite so short-termist. Are clients and have they become more comfortable or less comfortable with that over time?
Those are client-specific conversations, but it really comes down to the conversation. Our job as investment professionals is to help educate, talk through those things, listen to the client, and so we do a great job of doing that, and we think we can tailor the portfolios to their specific needs, timeframes, and help kind of refocus them from time to time. And this is one of those points in time where focus is key and conversation is key.
Emily, what about you?
Agreed. Completely depends on the client, but I would say my clients in general have gotten very comfortable with focusing on the long term. Because part of my job is to make sure that they understand this is not about 3 weeks from now or 3 months from now, or frankly, necessarily 3 years from now. This is the long-term discipline process.
Right.
But yeah, no, human nature, humans can be frustrating.
No, they're great.
But our job is to help them.
Thank you both. Great to see you in person as well. Emily, I think first time we're meeting in person. Chad as well. Emily Bowersock Hale, Bowersock Capital Partners, founding partner, and Chad Oviatt, who is Huntington Private Bank Director of Investment Management. Thanks to you both.
Thank you.
Really appreciate it.